Before you make a choice on your next mortgage or renewal, your professional should be going over fixed versus variable with you in depth. Now, I'm going to do it for you to make sure that you can make the best decision possible. If you do have any questions out of this, because it is a complex topic, feel free to reach out and I'll do my best to answer. So if you're considering a fixed mortgage, there's a few things you need to know. First of all, even if your lender did not show you these options, there's typically 1, 2, 3, 4, and 5-year fixed options. There are sometimes options for 7 and 10 years and sometimes 6 months as well, but primarily 1 to 5 years are most common. Now with fixed rate mortgages, particularly the 3 to 5 year options, you're looking at having the worst best case and the best worst case. So what I mean by this is that if rates go down, that's arguably your worst case. Your neighbor gets a cheaper mortgage, you're annoyed. But if rates go up, your worst case, or I guess your best case, I don't even know with a fixed rate mortgage, it doesn't get any worse, you're protected. So it's something to be aware of, but there is one thing you need to know, and that is fixed rate mortgages have penalties of 3 months interest or interest rate differentials. Now, 3 months interest is pretty straightforward, it's the same type of penalty as a variable, it's 3 months interest on the mortgage. But interest rate differentials are the tricky one. They are penalties that change over time and change based on how lenders adjust their posted rates. So if there's one thing you take away from this video, know that asking your lender what the penalty is on your fixed rate mortgage, and they tell you, is not necessarily accurate because it could change after 6 months or if they cut their posted rates, and then it can continue to change. For 5-year fixed as an example, we often see fixed rate mortgage penalties being 5 to 10% of the size of the mortgage, and it gets worse as rates drop. So your worst case in a sense is that rates drop and you're forced to break the mortgage, and now you're facing a penalty of tens of thousands of dollars. The largest I've ever seen was over $500,000 on a very large mortgage, so be very careful. Now variable and adjustable rate mortgages is a little bit different. They have a guaranteed 3 months interest penalty, but they have rates that go up and down. Now you may be wondering, what's an adjustable rate mortgage? Everybody says variable. So I want you to know that with floating interest rate mortgages, variable and adjustable, rates go up and down based on 8 Bank of Canada meetings per year. Now, as those meetings happen and they increase or decrease the overnight lending rate, banks will then adjust their prime rates. And you need to be careful because a couple lenders like TD have higher prime rates than everybody else. So they can offer you a bigger discount, but it's actually the same rate. So you do need to be careful because it can be a little tricky in this industry. Now, as the prime rate is adjusted, there's 2 variables a lender can change: the payment or how long till the debt is paid off. With a variable rate mortgage, they change how long until the debt is paid off. So they either shorten in the event that rates go down, or they extend in the event rates go up. So if you remember when rates were going up after COVID, if you remember reading about those 100-year amortizations, that was a variable rate mortgage this was happening with. Now with an adjustable rate mortgage, as rates go down, your payments go down. As rates go up, your payments go up. Overall, I prefer these products because they force you to deal with the reality of the situation right away rather than hiding it and going into what's called reverse amortization, which variable rate mortgages can do. Now these products have 3 months interest penalties, but they have an added bonus. And that is, these products allow you, so variable and adjustable rate, to convert into a fixed rate mortgage at a future date. So this can allow you to procrastinate the decision to lock in, which can have some added benefits. Now, one thing I want to mention briefly is that if the lender tells you not to worry about penalties because the mortgage is portable, you need to be very careful. Porting is something that you can do when you sell your home and you buy another home in an eligible time window, but you must re-qualify. So if you buy a more expensive home, a less expensive home, you move to another area, start a new job, these are all reasons why you may not qualify to port and be forced to pay the penalty. Even worse, some lenders have a porting policy of the same day or within 30 days as an example. So you need to be very careful that you know what the fine print is if you think this may be relevant. My best advice is to think of porting as a chance to avoid the penalty if everything goes right, but by no means a guarantee. So if you have any questions on choosing between fixed and variable, feel free to reach out. I can go through how fixed yields or bond yields control fixed rates or anything you want. If you want to know about it, just reach out, but I don't want to be too in-depth in this video. Happy to help, and once again, I always recommend getting started 4 to 6 months early at least. Chat soon.